At Farms.com Risk Management, we understand that commodity price risk management and sound financial advice are essential in today's volatile crop and swine sectors. Visit our website at www.riskmanagement.farms.com.
Welcome to the Farms.com Risk Management Daily Market Commentary for Friday, January 6, 2012. This is Mo Agostino, Managing Commodity Strategist. Well, today we're talking about those weekly grain export reports before the big report next Thursday, the WASDE report. And overall, other than meal and oil, the numbers were very disappointing. This could also be due to the holiday season the last few weeks. But let's start off with the beans. Numbers came in significantly lower than last week, in the prior 4-week average down 29.1% versus last year. Wheat, same thing, significantly lower both last week and the prior 4-week average down 10.2% versus the same period last year. And corn also down 6.1%. Sales to date are down 5.1% compared to last year. So bottom line, disappointing weekly grain numbers, but it's, again, 1 week, not necessarily a trend. I think the main focus still remains South America. We had a big down day yesterday, some profits because they're pointing to some more rain earlier next week. Not sure that some are convinced that those rainfall amounts, 0.5 to 1.5, will materialize. So the market's bouncing around even to slightly positive today. You can see on the chart there that we've got potentially a double bottom, bumping against the 200-day moving average on corn. This is the March contract at 667. For you to really move much higher than this, I think you're going to need another shock in the system. It could be next Thursday. To manage some of your risk, I think producers may want to think about selling some corn bushels in front of that report. Same thing with the July corn contract. You can see bumping against that 200-day moving average at 678. We did suggest that at some point we could approach that $6.74 to $7. We got to that 674. Unless South America gets a lot worse, this may be the high until next Thursday. And then, of course, yesterday canola futures actually performed a little bit better than soybean futures. Support came from confirmation that there's some more Chinese demand and a lower Canadian dollar. So you can see the run up there in canola prices as well. Not quite approaching that 200-day moving average, but nonetheless looking a little bit better than where we were. Chart of the week is the US dollar. Earlier in the week we talked about that golden cross signal on the charts. It's when the 50-day moving average moves above the 200 on a weekly chart here. The US dollar, you can see it's about to do that. US dollar up 8.2%. Again, this is largely because of a weak euro dollar, putting some pressure on the Canadian dollar. I'm not sure this is going to last as we move into 2012. We're not very bearish on the euro, although the euro dollar has been slowly moving lower. We think the probability is that euro dollar goes right back up. So, in other news, we've got hogs down hard yesterday, testing lows again. Wholesale pork prices near one-year lows going back to February of 2011. But this is temporary. Don't think it's going to really matter at this point. February contract eventually will come to an end here soon. So hog futures are up a little bit today, largely because also the demand has been slowly moving lower. You can see that pork carcass cutout, not in the hundreds or the 90s, back into the low 80s. So demand may be a little slow. We got holidays as well. Price support could be the most watched economic indicator in China. Yep, believe it or not, pork does represent about 3% of the consumer price index in China, but pork prices have caused inflation in the past for China, so some are suggesting that that's something to watch for with respect to demand going forward. You got U.S. unemployment rate falls to 8.5%. Month of December created 200,000 plus jobs, better than expected at 155,000. That's a good signal that the job market or the U.S. economy is stronger than most expect. So much for double dip recession. Everybody remember talking about double dip 3, 4, 5, 6 months ago? This is a chart from CNBC. It's called JOLTS. It's job openings and layoff turnover. And when you can see the green line there, when the green line, the quits, is higher than the layoffs, that's signaling a very strong U.S. economy. And when the quits is lower, it signals a lower or weak recession. 2011 best performing commodity. We've done this before in the past. We've told you top 10. Believe it or not, it's milk up 35.7%. That's amazing. Canada's jobless rate jumps to 7.5 from 7.4 last month, and we add about 18,000 jobs. Not as strong as the U.S. And an Informa is projecting slightly higher corn and U.S. soybean yields in next week's USDA WASDE. Corn goes to 147 versus USDA 146.7. Soybeans 41.8 versus USDA 41.3. This is a non-event. It's old news. I think the main focus still is South America. Until next time, thanks for watching. Have a great weekend. Take care.